Welcome to Driving Alpha, where we feature our friends, the outperforming investors who demonstrate their path to driving alpha or outsized investment returns. We're Alpha Partners, where we partner with 1,000 early-stage venture firms as their opportunity capital to invest in their best companies. Driving Alpha is supported by Affinity, provider of the CRM for the private capital relationship economy. Affinity knows who has the best relationship with the right startup. Affinity knows. Learn more at affinity.co/driving alpha.
Hi, I'm Steve Brotman, managing partner and founder of Alpha Partners. Welcome to Driving Alpha, the podcast dedicated to trailblazers shaping the future of venture capital and tech innovation. Today's guest is Ira Weiss, founding partner of Hyde Park Venture Partners and a recognized leader in early-stage Midwest investing. Ira's story is anchored in both academic achievement and entrepreneurial vision. He earned his undergrad degree in accounting and economics from University of Illinois, and then went on to receive his MBA and PhD in accounting and economics from Chicago Booth. Ira began his career as an accountant at Coopers & Lybrand before pivoting towards teaching and startups. Currently, Ira is a professor of entrepreneurship at University of Chicago Booth, where he teaches courses on entrepreneurship and startups. His passion for nurturing the next generation of founders is as evident in the classroom as it is in the boardroom. As a founder and general partner of Hyde Park Venture Partners, which he started in 2011, Ira has made over 150 venture capital and angel investments, fueling growth from early-stage technology-driven companies across the Midwest and beyond. Hyde Park is renowned for backing bold entrepreneurs, with Ira at the forefront of many of its most significant deals. Major portfolio companies under Ira's leadership at Hyde Park include Four Kites, ShipBob, and G2. We might even talk about Audit Site, an up-and-coming interesting company. And beyond investing, Ira's influence extends to thought leadership in startup finance and strategy, contributing insights through teaching and active engagement in the startup communities. Get ready for a wide-ranging conversation with Ira Weiss as we explore what it takes to spot entrepreneurial opportunity, drive transformative growth in America's heartland, and build the next wave of breakout startups right here on Driving Alpha.
Great to be on, Steve. Driving Alpha, super interesting podcast. I know you've had Jason Calacanis and some others on this, and really excited to share the little knowledge that I have with your audience.
Me too. It's great to have you on. We've known each other for many years. And, notably, my son just graduated from University of Chicago. I just got back, and he just started his career with Jason, actually, at launch. So,
how about that? Okay. How was his experience at the University of Chicago?
amazing. So he had a great time. Chicago's often dinged as the school where fun goes to die. I don't think he found that. I think he sucked the marrow from the bone of the school, got a ton out of it from professors like yourself. And, frankly, now that he's in Austin, where my wife said to me, well, that's where fun goes to live. So he's taking a lot of what he learned at Chicago, and super excited for him. And, I think Chicago really prepared him. So thanks to you and the faculty at Chicago. You guys did a wonderful job, and we couldn't have asked for a better result.
I'm glad you enjoy it. We're still trying to live down the old reputation of the University of Chicago, which is where fun goes to die. But I think it is a pretty different university now for the undergrads. And I think they both get a rigorous academic experience together with a more than adequate social life in a major city like Chicago.
He had a blast every minute of every day. He really did have fun. And, I don't think Chicago's for every kid. It's not everyone's taste, but for a student who wants to really explore their academic and intellectual horizon, that was really impressive. And he really did have a great time there. And I think the reputation, I think that is an older reputation. And clearly he truly enjoyed it and got a lot out of it. So anyways, changing channels back to venture capital. I mean, sitting at that intersection of venture capital and startups and entrepreneurship, how did that happen? That doesn't happen that often. A buddy of mine who started as an entrepreneur, is a professor of entrepreneurship at Columbia. Is just curious how that happened and how did you end up as a VC going from accounting to venture capital? That's not like a typical life pattern. So just curious on those two life paths.
Yeah, well, I really live in both worlds now, which I have for quite a while. I got, as you had mentioned earlier, I got my PhD from the University of Chicago. My first academic appointment was actually in New York at Columbia Business School. And I got out there in 1999 when the tech bubble was in its bloom. And a lot of my students were going off to work at technology startups. And at that point was really ready to leave my academic job to start a technology company or work at one. So a colleague of mine and I started doing some startup investing on the side. And I just fell in love with the early stage startups, just the energy, learning about what the future's going to look like, seeing how quickly things move along in the startup world. And so I did that on the side of being a professor for quite a while and eventually kind of morphed my career over into being able to do a bit of both. So that's how, and I think when my students ask me, how do you become a venture capitalist? I have different suggestions for them for routes, but my route is kind of a long route, but it's the route that I would call like self-trained in some way, where you start writing checks for startups and then just do it for a long enough period of time that you know a little bit more about what you're doing than when you started.
Out of a professor's salary, I wouldn't expect that you'd have a lot of like spare cash lying around to like throw at startups. But I guess in an angel like way, that's kind of feasible. Self-taught is probably not the biggest route, right? To venture capital.
No, I think it is not. I think some of the tried and true routes are like becoming an entrepreneur, starting a company, and then hopefully being successful enough at it that if you, after having that experience, want to turn over to the dark side, the investing side, you're able to do that. So that's a tried and true route. One of the downsides to that route is that most startups are not successful. And so if you know you want to be a venture capitalist, that is a little bit of a hard route to forge, even if it's super, super valuable. There are other routes.
Mention a couple others just because I think the audience might just find that interesting.
Yeah, I think another historical route, things are changing a little bit now, but another historical route, at least for my MBA students and some undergrads, is to go work in certain roles at quickly growing startups. And so those roles historically have been product roles and growth roles, because you learn a lot about go to market, you learn a lot about technology, you learn a lot about customer needs, you learn a lot about understanding, markets and how to orient a product towards the market. So, for some of my students who know they want an entrepreneurial career, they want to be in venture capital, but can't necessarily get one of those jobs right out of school, my suggestion is find a quickly growing growth stage startup that already seems like it's quite successful, but still early enough to have a good experience, get a product role or a growth role. Now it's changed a bit where obviously if you get an AI role, it's some data roles. I think those are also maybe more valuable now, but that is another kind of tried and true route to be able to, eventually turn to the investor side.
Excellent. So as you first started looking at companies, what do you feel like you look for today in terms of companies? And what do you feel like how that's changed from when you started investing?
There's like a list of things like our firm and we usually get involved really early. So, people would describe it historically as like, two people in a garage. Now it's, let's say 3 to 5 people, sometimes as many as 10 people. Usually for us, it's pre-product launch, although sometimes there's some, product launch and, maybe early product market fit. And so, there's a list of, let's say 10 things that investors in VCs really want. And many of them are things that wouldn't surprise anyone, large and quickly growing markets, things like network effects, if there's virality, a team that has some domain expertise. There's other things that we have learned over time are useful, especially for really early stage companies. And one of those may be a founding team that has worked together in the past. And so there can be a lot of ups and downs in really early stage companies. And so the more history people have together, especially the more of a working history, the more likely it is that they'll just be able to go through some of those ups and downs. There's a lot of other things that we really like that are the common things that VCs like, but it gives you a sense of the, let's say 10 things that we really want to look for.
And do you think that's changed in the current market with technologies like AI emerging? And
Well, historically, yes, a little bit about historically. When I started investing, you always know anyone who's listening to this podcast who's not, 50 or older like I am. Well, someday you will get to this point as well. When you look back, you're like, well, when I started that doing X, and when we started, you needed about $5 million really to get a product to market. And then for a long period of time, you needed, let's say $300,000 to $500,000 once, cloud and AWS, all the online tools, you could get a product launch with say $300,000 to $500,000. Now, I mean, really you just need one developer, right? If you're a founder, a developer or two, then they can effectively get a product into market. In some cases, you don't really even need a developer with some of the new tools. I guess Cursor is more technical, but the Lovables and other, low code things. So I think the world has changed a lot, and in the pace at which things are able to be tested by the market. And for investors and entrepreneurs, there's good and bad from that. The good is you may see a lot more things where it looks like there's some traction because they pilot or they have some initial customers, but there's just so many more companies out there doing very similar things that you have to really understand, what gives you some differentiated reason to be able to attack a market. Or sometimes you get into a market and you just have lightning in a bottle. So this is some of the consumer. We mostly do more business to business investing, but there are some cases where consumer companies get launched, there's virality, and you're able to develop those network effects where you have some kind of moat. And so once you see something like that taking hold, certainly we tend to get involved before that, but you can see that pretty early these days.
so let's take ShipBob as an example. Can you share a little bit about what you saw in ShipBob at the very beginning of that company and what it's become today?
Yeah, ShipBob does e-commerce fulfillment. And for people not familiar with that term, you order something from Amazon or you order something online, some box shows up at your door. Whether you order from Amazon or you order online, there's some company, sometimes it's Amazon, that will package up those goods and get them to your door. That is what ShipBob does. And it has become, I think most people would say, something like the Shopify of the e-commerce fulfillment world, where hopefully it is becoming the default provider for many. And you may think, okay, well, I order almost everything through Amazon. There's lots and lots of brands that you may order that may sell on Amazon and sell elsewhere, but they self-fulfill, or they may or may not want to be completely dependent on Amazon. So that is ShipBob, and it's become, I think we're obviously very, happy with the progress there. Early on, we saw a few things. One was the two co-founders, thinking about a theme that I had talked about earlier. The two founders actually grew up together. They grew up together in India. They both came to America for college. One went to Purdue, one went to University of Illinois. They got out of school. One of them went to work at one of our portfolio companies as a software developer, and the other went to work at Deloitte as like a supply chain expert. And so they left together to start a company. And their first company, they ended up pivoting it into ShipBob. And so we got to know them a little bit when they started, but their first idea was not going to be the $1 million idea. And so, but once they pivoted, there was a little bit of early traction. And between the founders being super interesting, founders for us, and then also a market where you looked ahead at e-commerce fulfillment. This, we got involved in that company about 10 years ago, but you looked ahead and you're like, well, this is a market that's going to grow, 15 to 20% for 20 years or more. And so all of those things made some of the initial idea like, oh, this could be really exciting. Now, there were some concerns. It mostly sounds like a service and not like software. And what was interesting about the founding team and their model is they were going to try to solve everything they could using software. But of course, some of what they had to do and still do is the physical service of boxing things up and shipping them out. And so that's some of what we saw early. Really, really large market, growing quickly. If you did a search online and you looked for e-commerce fulfillment provider, you might find 300 different companies doing it, maybe more, it could be 1,000. And so that, as a VC, the one hand, maybe it scares you a little bit, like where are all these little companies and no one's become really big. Or you could say, oh, well, it's a very, very fragmented market. Most of these companies don't have a lot of technology. If someone could come along and really think of software first for every pain point in the market, maybe someone could create something. And then for a company like that, there are network effects in a lot of these logistics plays, where once you get large enough and you have fulfillment centers in multiple parts of the country and you have enough shipping volume going through, your cost structure actually goes down and your ability to ship becomes much quicker at a lower cost. And so those kinds of network effects make for interesting long-term moats for companies.
When you first mentioned it to me, I was like, wow, what a tough business, the fulfillment business, and kind of gritty and not software, to your point. What was it that maybe it was 10 years ago, so that was a while ago, but do you remember what the hook was? That was like, oh, we've got it. But what was the itch that you needed to scratch to learn more? Do you remember, like, what was the thing about it that you were like, we need to have these guys in again? Do you remember what that might have been? Was it the market size? Was it just the grittiness of the entrepreneurs?
I would say the founders' connection with one another and how smart they were and their grittiness, together with the interesting market. At the time, actually, there was this movement in the Bay Area where companies like this that required a lot of physical service, even if there was some software, were kind of heavily on the downswing. So there were a bunch of companies in and around the space that, frankly, it was clear they were failing, but it just is such an incredible, juicy market. And the founders were clearly, the other thing is, one of the things we look for in our opportunities is how sticky is the service going to be. It's one of the reasons I don't do that much consumer investing myself. I consume, but I don't do that much consumer investing. A lot of these companies, it's like, there's 30%, you have 30% of your customers left at the end of the year. And it just kills me. It's like, oh, we have to replace the 70% that we lost before we even grow. And so one of the nice things about this company, and the founders realize this right away, is like, well, fulfillment itself is really sticky if you're good. Most people don't like their fulfillment provider, but if you're good, it's really sticky because the fulfillment provider has your inventory, has own your inventory. And the second is business to business software, if it's mission critical, can also be really sticky. And so you had two different things that could make it sticky. And that has shown the test of time for this company. If it has customers, some of the customers it joined, originally it was focused on small and medium-sized businesses, but some of those companies have become extremely large businesses, and they are still able to fulfill with ShipBob, and they are still fulfilling. Certainly they have customers cycle off here and there, but they've had a lot that have stuck with them over many, many years.
Sounds like an interesting company, and
Yeah.
look forward to hearing where they end up.
And maybe getting back to what you look for, so I like things that are really sticky, and entrepreneurs like things that are really sticky too. So what are the characteristics that make for a sticky product? Well, mission critical data that people need to use, maybe a lot of users who are using it every day. You think the classic example is Salesforce and, customer relationship management software. Many, many people in an organization are using it every day and putting information into the system. I think as a young investor, I underappreciated the importance of lots of people using it. How mission critical is it? How important is the data to people over time? And does that data, the further you get in the company, it's not as true in the AI world anymore, to be honest with you, but the more data you have, the bigger the network effects can be. And so it's something else that was just interesting to us early on with this company.
Are there any other companies that are up and coming that you're pretty excited about?
Yeah, I think you mentioned one earlier where there's a company called Audit Site. I'm actually an accountant by training, and I got a PhD in accounting. I audited for a year at an accounting firm called Coopers & Lybrand. That's now PwC, part of PwC. Pricewaterhouse merged with Coopers & Lybrand. And so Audit Site automates financial audits, and it also automates quality of earnings audits. And for anyone who's been, if you're involved in a company that goes through an audit, our fund is audited, it can be a pretty painful, arduous process. This is software actually that's used by the external accountants themselves to do the auditing work, to automate the work on their end that just really, really streamlines the process. And so that is one of the up and coming ones in our portfolio that I would say I'm pretty excited about, or we're pretty excited about.
Yeah, I mean, are there, once you do the auditing, do you start doing the taxes? Is that in the queue downstream? I mean,
Not this specific company. The answer is no. There are a lot of people who are trying to automate the tax side, and that feels like it's moving along pretty quickly. The audit side is a very different animal because it's a different type of regulation, and auditors are very careful about. They're worried, okay, if something's wrong with my audit, am I going to get sued? There's a certain amount of risk involved. And there's regulation that's not like IRS Treasury regulation, but it's more other kinds of government agencies. And so it is a market that has moved slower. And I think you need to know the intricacies of doing the job a lot more. So that company in particular, I predict it will always stay on squarely on the audit side. It also does work on the transaction advisory side, which is something called a quality of earnings, in many cases, a quality of earnings audit. So for anyone who's been through, if your company goes through an acquisition where you get acquired, or you're a bigger company and you acquire another company, many times, either when you're being acquired or you're acquiring a company, you want to, maybe the company's already audited, but you really want to know, okay, is there anything underneath that I should know about? Is there any like temporary fluctuation that is masking something? And so a lot of acquisitions, as part of the acquisition, people need to do a quality of earnings audit. And so that is something also that is automated by Audit Site. Again, it's used by a quality of earnings provider. And so they use the software, but that is a process that can take 6 weeks and cost, $75,000 to $125,000. And Audit Site, that doesn't automate the whole thing, but it can probably reduce that time frame from 6 weeks down to, frankly, a few days. Audit Site is almost instantaneous, but there's still some work that the financial auditor needs to do.
and AI obviously is impacting that whole process stream, right?
Well, that is Audit Site. It has aspects to it that are algorithmic and aspects to it that are AI. AI has done a lot of incredible things for our companies, but one of which is the ability to create new products, create new modules, really is pretty remarkable. The one watch out for it in this specific world of auditing are the hallucination problem with AI, which I think we're getting better at. We meaning like the world is getting better at navigating that, but auditors are not really comfortable with a world of, oh, okay, you're telling me 1% of the time this system is just going to make something up. And so it doesn't really work for financial auditors, so that the way that companies like Audit Site use AI is a little different than, the way consumers or business folks might.
It just struck me that there's sort of like a tick and tack, how auditors like, okay, this is here. Are they lined up the right way? It seems like AI could actually use like an internal system, because the human mind fools itself, sort of credit and debit. The whole auditing system is designed to remove that bias. I wonder, some AIs can use a similar type of dynamic so that they don't fall for the same hallucination. But then you got a hallucination on that as well, I guess you can worry
You're
about.
good at this. So were you an auditor for a while, a CPA, accountant? Like how did you come to this
Oh,
knowledge?
actually, I work for Accenture. I have my own academic. I got a JD MBA, so too educated to be VC, I guess, but apparently not. As a PhD, there's not that many PhDs in accounting and as VCs.
We are probably a rare breed.
Yes, probably. What would you say about, is there more to say about how the AI world is impacting a company like ShipBob, which you invested in 10 years ago? Are they starting to adopt AI at all? Are you not that worried about it? And, anything else in your portfolio, how or even new companies that you're looking at, the speed of the growth of that segment, has anything you can share on that front?
I mean, I think AI permeates all of our companies at this point in some way. Like our companies have adopted it. The new investments we make are, all AI related investments in some way. Even ShipBob, that sounds like a company that, it's like physical fulfillment, but it is the underlying technology is all software. And so there's many, many things that they're using AI for that really has just sped up their pace of innovation. I was already a very innovative company. I think it's a remarkable world. It's like the platform shift of moving to AI has been so quick relative to, like, I lived through the world of moving to the internet. Like I was in college. Actually, Mark Andreessen went to the University of Illinois when I was there, and I wish I knew him, but I was in like the computer labs, and I would see these like original NCSA browsers or whatever they were, NCC, whatever it was, a national supercomputer. But it was done. University of Illinois was one of the places that it was done, and you'd see it, and you're like, well, what can I get? And you like could get just some weird government data. And I just had no idea how powerful it would eventually become. But it took many, many years for the internet and the power of the internet to fully be adopted. Then you had the movement to, an example, movement to mobile, which was relatively quick, but still took quite a while because people had to adopt mobile. And then, the benefits of it, then the move to things like the cloud for the business world, the AI adoption curve has been so much quicker because it's, in many ways so much more powerful. And that is remarkable for people who are investing because there's lots of disruption going on that makes for opportunities for us, this, to answer the why now question, which is an important question on the investing side and the entrepreneur side. But also, you could have a company that you've invested in that if it doesn't adopt and adapt quick enough, its market could be overrun pretty quickly. And so it's not really a double-edged sword, but you really do need to be focused on what's going on in the world right now. There are companies such as ShipBob where there is an underlying physical service that the company is doing. And so, if someone came along and, they had much better AI, it doesn't mean that they would necessarily have much better, like the physical infrastructure and the fulfillment that someone like ShipBob has gotten together. But for a lot of our other companies, what are the moats? The install base, the data, the number of users. But over time, there'll be fewer and fewer physical use. Like what I said earlier is going to become less true. So like the number of, how do I know that something's sticky? Well, lots and lots of people are using the software. In an AI world, there are fewer people that you need, right?
Less seats.
I mean, nobody tries to sell by seat anymore, but it's still, when I think of, okay, like how sticky will this be? Historically, my mindset was, oh, well, like how many people use it? How regularly do you use it? How critical is the information in it? It's like, oh, well, if the AI is really good, at the end of the day, instead of having 100 people, maybe there's just like 1 or 2 people using it. It's like, okay, I guess it's really sticky, but it's only 1 or 2 people. Now we're back to 1 and 2 people. So we have to maybe change our paradigm a little bit. And that's, honestly, it's wonderful for the world in many ways. And it's also a little bit of a scary time to be an investor in given how things are moving so quickly.
Well, scared to be an employee, right?
If you're not adapting quickly, that is very true.
Have you seen it seep into academia or the teaching market? Has there been any impact just yet? Or is it pretty much steady as she goes?
I mean, I think it has increased the pace of research in the academic market. I think academics are actually pretty quick early adopters of technology to get ahead in general. We certainly have seen this on the statistics side and, the software side. I think the thing that academia struggles with it now is like, well, my students can often just take my homework assignment and put it into, ChatGPT or Perplexity or, Gemini, whatever it may be. And it's like, how much work are they doing versus the system? So, we had moved to a world where we were doing more and more tests online, but at least for the final exam. And now, we do actually have faculty members that are moving back to having more in-person exams where students are, you kind of have an environment such that you control the environment a little bit more to know what the real knowledge is. Now, that's temporary. Like what we really want is our students to use whatever tools they have available to learn the most and to do the best job. But I think that is something academia certainly this copyright using AIs, we're certainly struggling with it.
It's interesting. My son was talking about there's some kids that don't use any AI and do all the assignments and don't leverage anything like that. And then there's some kids that leverage it to the hilt and figure out all different ways of how to do better. One can argue that the kid who leverages all those AI tools is going to do better in life, right? But at the same time, you worry that maybe they're going to miss something, like a real skill, like being able to write or think critically. What do you think about all that stuff?
I mean, I think it is a tool that you want to use aggressively to improve yourself in a school setting, improve your knowledge. So I think it's great for students to use it a lot, but if it means the whole quarter or the whole semester, all of their assignments were done using AI, and then they show up and, if they don't have the crutch of an AI software platform, they have no idea how to solve something, then I don't think that student is better off. The students who are better off are ones that, they can use it to improve their knowledge and get knowledge quicker and tackle things. Sometimes I have some students who use it to help them learn. AI, explain this to me. Here's the kind of stuff that I understand. Explain this to me in terms that I will understand. And so those are the examples of how it may quicken up your knowledge. And I think it's not going anywhere, and it's only getting better much, much quickly.
I'm going to shift gears a little bit. You mentioned sort of this multifaceted way of looking at things like stickiness and market size and, founder chemistry. And, I was just curious. And I've been thinking a lot about this at Alpha, like Hyde Park. How do you come to a decision? Is it an IC that everyone votes and it's that, or is there a partner and it's all partner driven? And if the partner wants to do it, they go do it. How does that work? Because there's lots of different reasons to say no, right?
Yeah.
Only a couple reasons to say yes. So how do you manage that process?
We do have a voting system. My partners and I have some mentors, and we kind of vetted a system and kind of gleaned a bunch of information from these mentors to come to our voting system. There is a formal investment committee, and so the formal investment committee does need to vote on it. But what we'll do is, present a bunch of information, and in an investment committee meeting to the entire team of investment professionals, everybody gets to vote. And usually we always want the most junior person who is not working on the deal to vote first, because, if they vote last, they can, the breeze will maybe push them in one direction or another. And so you have the most junior people vote.
Really? Is it literally go around the room, thumbs up, thumbs down?
No, it's we ask everyone verbally to rate it on a scale of 1 to 10. And then also yes, enthusiastic, yes or no. And so everybody does effectively two votes, which is a number scale. And you could say, look, there could be things where you're super enthusiastic about the company, and so you do yes, enthusiastic, but maybe you're not so excited about the valuation, or you're not so, who knows? You're not so excited about the certain aspects of the investment profile. So maybe you're voting it, your number's a little lower. So we try to tease out as much information as we can using that system.
Is it anonymous, or do you have a covered vote, like a piece of paper, and then everyone shows their hand? Or
Yeah, ours is not anonymous. We do have people, because we also want people explaining. You don't have to explain, but you're like, well, look, I think yes, X is true, but I think this is a market that will undergo a lot of changes over the next few years. It's really unclear how it's going to play out. And so even though, super interesting team to do it, there's 15 other companies doing it. We want that color to come out. And so therefore it's not a private system, but there are formally 3 people on the investment committee, myself and the 2 main partners. And so you got to win 2 of the 3 votes. We don't want it to have to be unanimous, because I think it just creates a little bit too much tension in the process. But everybody in the room will have an understanding of where people stand on a specific investment, and whether you're getting a lot of negative feedback on it, generally you feel like, ooh, okay, people really don't think this is a good idea. I'm going to go back and think about this for a while longer. How do you guys do it? Because I know you Your model's a bit different, but do you guys have the similar kind of voting system in place?
It's similar to what you suggested. We try to start at the juniors and get their opinion, but it's not a formal yes, no. It's a bit of a vibe. We're also a lot different than where you sit. We're like, okay, Bain's leading the deal. So, General Atlantic is leading the deal.
Yeah.
Bessemer is leading the deal. And it's not that that's the end of the conversation, but the quality of the opportunity that we look at. I just heard this about General Atlantic, and I don't know if this is true, but I understand that they did an analysis of companies that went to the IC and they decided to go forward, and deals that went to the IC and they declined. And guess what the track record was? No difference in outcome. Well, it just shows you the quality of the opportunity that General Atlantic has, right? Because if there's literally no difference, that means that the work that gets done to get to the IC is quite high. So by the time it gets to us and, GA and Insight, and by the way, it's not just a daisy chain of those firms. I'm just sharing with you the quality. And there's a couple times where we're looking at a deal and we're like, this is insane. But what was IBP thinking? Right? There's some things that when we actually do chat with a lot of folks on the board and get that feedback. But from a decisioning process, we do have a senior team. And ultimately, I think to your point that you don't want to have it unanimous. But a lot of times the real question is there someone in the room that is just standing on the desk and hammering down and being like, we've got to do this. And no matter what you tell them, they have a pretty good response. Like they've read the material and they're prepared. And, I think that's the tricky part. And, I think from that perspective, it does seem to work, but ultimately it is a consensus driven thing. I think if some people are like standing on the table and saying, we're crazy to go do this, that also helps too, but it is definitely consensus driven. We don't have a formal thumbs up, thumbs down. I think that's, it's a little different in that respect for us. But, I just, as I get older, I start thinking about this stuff. What is it? And it's great because I'm interviewing every, VC every week, just hearing how they do stuff. And there is no right answer. It's just interesting how different firms evolve. One firm I talked to, they're like, yeah, we don't even have a vote. If the partner wants to do the deal, they get to do the deal if they want to. And we get to share what we really think. And the partner takes that into account. But if they still come back and say, no, we're going to do this, then they let them do it. It's kind of interesting because the non-consensus deals are often the most successful, according to VC lore, is that the ones that are the most divisive are the most interesting. And we live in like this power curve type of world. So, which brings us to an interesting question that I'd love to ask you is that, your genesis is in the Midwest. I mean, obviously you spent some time in New York and you ended up in the Midwest. How do you think about Midwestern entrepreneurship? Is it any different than the East Coast or the West Coast? Is it typically a different focus, a different vibe? Anything, is there a different dynamic on how you look at this? Because I know you've been a big proponent of the Midwest and investing.
I mean, I think, you can start a really successful company, a company that becomes really successful almost anywhere if you have the right founding team for it. So you see, Shopify built in Ottawa and, these great companies built in New York, tech companies built in New York, and companies really built all over the country. And, most of the biggest successes have been in the Bay Area. And now to some extent, they're starting to be in New York. So I think for us, there are, the Chicagoland area is about 11 million people. There's a bunch of other really big cities throughout the Midwest. There are, I think pound for pound, we don't really hold our own in terms of starting companies, but there's a lot of people who have deep knowledge in the sector that they've grown up in. And so those are the kinds of things that what we tend to look for are entrepreneurs who have an advantage with something usually where the Midwest has an advantage and or the entrepreneur themselves has an advantage. And usually that is, they grew up in a certain industry and they know it better than others.
Give some examples.
Yeah. I mean, Four Kites is one of those examples where the founder, Matt Ellinjagoll, had been at a company called JDA Software for a bunch of years. He was at a company called i2 that was bought by JDA. And so he had spent many, many years in supply chain software. He was in Chicago. Chicago is, one of the, if not the founding city of the trucking brokerage industry. There's a lot of trucking brokers that are based here for a variety of reasons. And so you see a lot of logistics related software companies, logistics related companies in general. And I think that is an example where he was here. I think he was here for other reasons, but logistics is just one of the bread and butter kinds of things that groups like ours will invest in the Midwest.
Yeah. And when you see it, it, just like your ShipBob example, or even your auditing company. That's, a lot of the big 4 or 5 are in Chicago. And, there's that element. What is it that if you could go back and tell your younger self, what is it that you know now that you wish your younger self knew of? You had to name 1 or 2 things that you wish you knew back then.
I think usually the most successful outcomes are founders who can take companies all the way. I've always appreciated that, but, it's really, really difficult to make changes to a founder CEO over time. VCs try to avoid it. And, it's so, unless it's the founder putting their hand up, it's so disruptive. And so thinking about that early and whether this founding team has someone on the team who really can grow the company at multiple stages and can grow to be the right CEO at various stages. I think I underappreciated that early on, but then I appreciate it more over time as time goes on. I think I also underappreciated network effects early. I wasn't looking for them. I didn't understand as much about them and how valuable they could be, both for stickiness and also just for, being able to dominate markets and having moats. And so I think those are the things I tend to look for a little bit more now than I had in the past.
Ira, this has been an amazing chat. Thank you so much for coming on the pod. It's amazing what you've done at Hyde Park, and, wish you well to continue to impart your wisdom on the future generations of Chicago students.
Thanks for having me on. I think we've known each other, 13, 14, 15 years from some of your connections in Chicago and some breakfast that you have. And so Steve is like one of the hardest working people in this business. So he's always there.
Ira, you flatter me, but, we did that. I remember one of the first things we did was JD hosted a breakfast. It was wildly successful. I think we had like 80 or 90 VCs there one breakfast. And today we host breakfasts in San Francisco, New York, Austin, LA sometimes. And, it's just grown and grown and grown. You've really taken the mantle in Chicago, and that's what it takes to grow an ecosystem. And of all the ecosystems, I'd say Chicago's is probably the tightest, where you have the best, the greatest number of GPs at the partner level attending the breakfast and going. And that's really a testament to your hard work in Chicago, helping grow that ecosystem there. And that's why I enjoy coming is, I try and get to Chicago twice a quarter or so. And part of the reason is just I think that it's a little bit of a contrarian bet. You noted that a lot of companies come out of New York and San Francisco, but when you're right and you're directionally right and the market is contrary to that opinion, that's really when you can make huge types of returns. And, Chicago, I wouldn't count Chicago out by a heartbeat. It's got great people, and I always enjoy visiting, especially you, Ira, and a lot of the VCs in that ecosystem. And great to hear your stories, and I can't wait to see the next chapter. So thanks again for coming on the pod. I'm Steve Brotman. This is Driving Alpha.
Thanks for listening to the Driving Alpha podcast, where we host top investors to demonstrate how they outperform the market. Click subscribe so you don't miss future episodes. Driving Alpha is supported by Affinity, provider of the CRM for the private capital relationship economy. Affinity knows who has the best relationship with the right startup. Affinity knows. Learn more at affinity.co/driving alpha.